Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is around the subject of whether it makes sense to place the shares of a family investment company into a discretionary trust. Okay, so many advisors other than ourselves do advise that family investment company shares be placed into a discretionary trust. So why is that? So there are some advantages, to be fair. The gift is a chargeable lifetime transfer, and therefore after 7 years it would be outside of your estate for inheritance tax, so that's an advantage. The trusts also provide a much higher level of protection against issues like your children or grandchildren getting divorced. The value of the gift, however, is limited by the trust allowance of 325,000. So if the value of what's in your company is a lot higher, and for many clients property portfolios are significantly higher than that, you are limited to the amount you can put into a normal discretionary trust. But also you may, as part of your overall planning, want to use your own 325,000 trust allowance for other types of trusts like flexible reversionary trusts, which really help in your own personal financial management in case you want money back during your lifetime. Now, because of its structure and why we don't normally recommend that family investment company shares be put into a discretionary trust, is that the structure provides protection from the loss of assets in the divorce in the event of children and grandchildren. And of course, effectively, a family investment company is not limited by the amount of the value of 325,000, nor is it limited by the length of the lifetime of a trust, which is 125 years. So although I agree a discretionary trust will provide a higher level of protection in the event of divorce for your children and grandchildren than the family investment company, those other limitations generally mean it's not the most sensible route. In addition, placing family investment company shares into a discretionary trust has an impact on taxation. It can make things quite complicated in working out your tax. It'll also generate higher accountancy fees as there is a requirement for this particular type of trust to keep records and then provide annual tax returns to HMRC. So straight off, you're talking about £1,000 extra a year just because you put the trust into place. So usually the reasons for most people to put assets into trust is to avoid the inheritance tax and take them out of the estate. So with family investment companies, we already achieve this aim of taking the assets out of the estate using other methodologies. So for instance, if we're going to set up a family investment company with investments, those investments have to be liquidated. Sure, there's CGT issues and one would need to check that. And then generally cash is placed into the family investment company. You can't transfer assets straight across. But then we advise you to give the capital shares of the children away to your children or to your grandchildren, and that's effectively a potentially exempt transfer. So again, it's outside of the estate for 7 years. So when people place investments into a company, to a family investment company, it's usually in exchange for a director's loan, and therefore that director's loan can then be utilized by the person to get tax-free income out of the company for the rest of their lives. But because it's still in their estate, by the time they're age 75, we then advise them to give up any director's loan to their children, which is a potentially exempt transfer, and then they live 7 years, and then that's the IHT problem solved. Now, with people who are setting up a family investment company with rental properties, okay, now we're saying, okay, there's a capital gains tax liability buried in the shares. Watch some of the other videos to understand that. And then the shares are gifted to an employee benefit trust. So this takes it out of the estate immediately. So there's no 7-year waiting here, and there is no CGT and IHT liable at the same time. So again, watch some of the videos on employee benefit trusts for that. So people then say, well, what about the future growth of the assets? Well, the future growth is allocated to growth shares for your children and grandchildren. So that doesn't generate any IHT because the growth will be outside of your estate. So if you get rid of the capital shares and no growth arises in your estate, no inheritance tax is payable. So it solves the problem in a different way. And therefore, in most cases, we don't advise that family investment company shares are placed into a discretionary trust, because usually people want to use their trust allowances in a different way for other assets, thus diversifying what's happening. And certainly we're saying to people, use their trust allowances in preference, interestingly, to a discretionary trust, not for rental properties, but for investments. And therefore it's a balance of doing both is the idea, and therefore you need the advice to make sure it's being dealt with properly. And therefore, in summary, the decision as to whether to place shares of a family investment company into a trust is decided on an individual client basis, and you need the advice from an experienced practitioner to help you deal with that. So yeah, it's considered individually, and then we would advise you individually. So there's no hard and fast answer, but usually in the majority of cases, family investment company shares are not put into a discretionary trust, to be clear. Okay, that's it. Hopefully you found that useful. Thanks for listening, and bye for now. Bye.